Happy New Year. Wow. January 1, 2023. 2022 goes down in the books. I don't know about you, but it was an incredibly fast year. But tons of headlines, certainly a lot of headlines that impacted your finances, the economy, and your retirement. We're going to talk about all of those events that happened during the course of last year, particularly this massive bill, the budget-busting bill that was passed. That also has a tremendous amount of changes to your finances and retirement in it. Some good, some bad. We'll break down in general bullet points on the program those changes. And then, of course, the moment or the portion of the program that you've all been waiting for. It is the first program of the new year, so that means that we've got our annual fearless forecast to make on the program. The little tongue-in-cheek exercise that we've been doing for 20, 30 years on this program that basically means that we're looking at our crystal ball and shaking it up and looking at what our prediction will be for the markets in the year 2023. We'll also tell you how we did for 2022. Here's a little hint. We were a bit off this year. So anyway, welcome to the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio program, also happened to be one of the most listened to programs, coming to you on a host of stations throughout the Central Florida region. And on the internet, our podcast happens to be one of the top 25 financial planning podcasts. So to connect with us, just go to our website, Nelson Financial Planning. Upper right-hand corner, you'll see a bunch of icons. Click on the one that looks most familiar to you, and you'll get immediately connected to our channel on whatever platform you desire, whether it's YouTube, if you want to see the video of this program, or if it's iTunes, Spotify, any of that stuff, you'll find us. My name, of course, Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning. So certainly hope your new year is going to be a happy and safe and healthy one. Last week, the last week of 2022, saw some major legislation get through that impacted a host of things from a financial and retirement and tax perspective. Now, all of this, it just passed. It's like a gazillion page bill. Nobody's probably read the thing through and through. Certainly before they voted on it, they didn't bother to do that because they don't do that. But anyway, we've got some of the highlights. And then in a couple of weeks, we're going to have fellow certified financial fiduciary and also fellow certified financial planner, also happens to be a CPA, Kristen Cayley of our office at Nelson Financial Planning. She's going to be on in a couple of weeks as we sort of unpack some of the details about some of these provisions that passed this past week, along with some announcements out of the IRS as well that sort of changed the game on a couple of things. So today's program, we're just going to kind of hit the highlights, make you aware of what's cooking, if you will. And then in a couple of weeks, once we've kind of had an opportunity to kind of really dig into the details of what's cooking, then we'll get into it in more detail. So, it's funny, every year around this time, we do a top 10 tax change letter. For many years, I was the one who wrote it, and over the past several years, Kristen has been the author of that top 10 list. And so she gave it to me earlier in the week, and I looked at it and I said, "Oh yeah, this is this sounds good, looks good, yep, all good." And then lo and behold, this budget bill passed, and man, they just packed so much stuff into it that it just really is just surprising how business gets done in Washington. So certainly that bill had a lot of stuff in it, which basically caused us to completely rewrite the top 10 tax changes for 2023. But also this past week, there was a couple of announcements out from the IRS. And one of them in particular was sort of a gift to the folks that have those side businesses. If you listen to the program, I think it was about 3 or 4 weeks ago, we got into this whole big discussion when Krista was on the show about the threshold that different companies like your Venmos, like your Cash Apps, like your eBays, all of that, we're going to have to observe in generating out tax documents that then you were going to then have to use and report on your tax return. So that was really just a mess. And if you recall the show, we really were kind of poking fun and really questioning the logic behind how that was going to ultimately be decided and determined, because ultimately, if you think about it from a tax perspective, if you recall, it used to be that the threshold was you had to have sales totaling like $20,000 and 200 transactions. And what the folks in Congress had done is they had passed a bill that said, well, we're going to lower that to just a gross threshold of $600, even on a single transaction. So that meant that folks were going to get a lot more tax documents and really kind of be scratching their heads about it. If you recall, we were talking about the difference between selling like Taylor Swift tickets on Ticketmaster versus the Magic on Ticketmaster. And like one of them you'd have a profit and one of them had a loss, but you can't really use a loss because it's a sale of a personal item and that doesn't count and because it's not a capital asset. So the whole thing was just a mess. And there was certainly many folks in the tax world that were talking about it as much as we were over the course of the past month. And lo and behold, the IRS listened. That might be a strong word, but they agreed to suspend that requirement. So if you were concerned about the tax document that you might be getting because you sold a sofa on eBay, or because you have a little side business where you make some handcrafted thing and you sell it on Etsy, or if you had a online gift exchange or a gift portal, all of that is no longer on the table right now, but it is on the table for the future. So it's a good opportunity if you do anything like that to make sure that you're maintaining good books, records, things like that. But at the end of the day, the IRS did suspend that. So the rules at the end of the day were really confusing and not very clear. And the thresholds and who it was ultimately targeting, it certainly wasn't the wealthy that they were targeting on this particular tax change. So anyway, that one is suspended, but be aware, suspended does not mean eliminated. So that is still lurking in the background. Similarly, as it relates to cryptocurrency, the IRS also issued guidance that said, we're going to suspend the requirement of your crypto broker to issue out tax documents showing gains and losses. Typically on a brokerage account, you get a tax document at the end of the year that says, okay, here's what you sold, here's what you bought, here's the tax implications, things like that. Of course, the motivation, I don't know if the motivation is there to require it, because the reality is most of the stuff involving crypto is at a loss. So if it's at a loss, it actually would have saved you money on your taxes because you would be reporting a loss. So I guess that was easy to suspend because the IRS really wants to collect more of your money and not less. So we'll just suspend this requirement to issue out this particular tax document, because at the end of the day, it might actually benefit the taxpayer. Anyway, we're going to take a break and return and talk about some of these big tax changes that happened last week to your retirement here on Dollars and Cents with Joel Garris of Nelson Financial Planning. We got a jam-packed show. Happy 2023. Happy New Year. Hope you have a safe and happy year. On the program, we're breaking down some of the big changes that happened just this past week. Before the break, we were talking about a couple of things that the IRS basically suspended in terms of enforcement or the obligation for companies to generate out 1099-Ks at the minimal threshold that they were lined up to do. The reality is that is a positive development. Certainly, if you're looking to eliminate confusion in question on your tax return. Also eliminated the requirement of crypto brokers to send out 1099 tax documents. Unfortunately, though, that one you may want to dig a little bit in on that, because the reality is if you're like most people owning crypto this year, well, you lost a bunch of money, and that money is a loss that you can take on your tax return. So as much as the first one sort of benefited people, the second one, probably did not. But anyway, that's how it plays out when you're talking about the IRS and Washington. Speaking of Washington, they jammed a bunch of stuff in that spending bill that passed last week. Here are just some of the highlights, or we're going to share with you some of the highlights. And again, Kristen Cayley, fellow certified financial planner, certified financial fiduciary at our office, Nelson Financial Planning, going to be joining us in a couple weeks to get into the details once we've had an opportunity to kind of read this, digest it. But we just kind of wanted to hit some of the highlights for you on the program today. So welcome into Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week. Wow, talk about a great week to do it, right? Beginning of the year, New Year's resolutions. I'm going to get my finances in order, or I'm going to get a second opinion of what I am doing. Perfect time to do that. Give us a call at the office, 407-629-6477, or visit us anytime on the web at nelsonfinancialplanning.com. We've got a team of folks that stand ready to help you improve your life with a successful and cost-effective financial plan. So here's the big changes that happened this past week. Number one, your required minimum distribution age went up again. For the year 2023, it is age 73. It'll go up even more over the subsequent 10-year period of time. By the year 2033, it will be age 75. So required minimum distribution age, once again, clicking up. It's gone from like 70 and a half up to 73 within like a 2.5 year period of time. So new RMD age in terms of the age at which you have to start taking money out of your accounts, out of your retirement accounts. Also good news, if you miss the required minimum distribution, there's no longer a 50% penalty. Now, that 50% penalty was one of the highest in the tax code. And so what it meant is if you missed taking your RMD, you had to pay half of it as a penalty. Oh, by the way, it's also taxable. So very quickly, it can get chewed up if you miss it. Well, the folks in Washington have reduced that 50% penalty down to 25%. Plus, they also gave you a little forgiveness aspect to it. The penalty for missing in the required minimum distribution will actually drop all the way down to 10% if you take the necessary required minimum distribution by the end of the second year following the year that you should have taken that required minimum distribution. Certainly, this was a heavy penalty. Great to see it go down. At the end of the day, we didn't really see it getting enforced all that often by the IRS. So maybe by dropping it to a more reasonable threshold, you may see increased enforcement on this one. But the reality is that is good news, that if you were forgetful, forgot to take the RMD, didn't realize it, or whatever the case may be, the penalty is much less, 50% down to 25%, and then also you get the option to sort of fix it in the following year, and there the penalty would drop all the way down to 10%. So a nice change for taxpayers there. A win for the insurance lobby. It seems like the insurance lobby always wins, particularly when we talk about annuities. You know how we feel about those products if you listen to the program recently. I think that was 3 or 4 weeks ago as well. You can now combine balances and calculate total required minimum distributions. There's also some provisions that allow for the acceleration of payouts, of premium, of income streams and things like that on the annuity side of things. Also, the $100,000 limit for qualified charitable distributions from your IRA is now going to be adjusted for inflation starting in the year 2024. There's also a provision that allows you a one-time extra $50,000 of a qualified charitable distribution from certain charitable trusts. That actually starts this year in the year 2023, allows you to do sort of a one-time $50,000 kind of charitable gift. Also, and this is one that, and again, a lot of these, we got to get a lot more detail on. This is all just kind of brand new and haven't seen really any guidance or regulations issued on a lot of these. But another one that caught our eye is there is a provision for rolling up to $35,000 from a 529 into a Roth. But the caveat there, as we understand it, is that the 529 has to be in existence for at least 15 years. So again, a lot of details. We wanted to just kind of share with you a lot of details that still need to be filled in. So we wanted to just sort of share with you the overview of some of these big changes that had happened, particularly over the course of the past week. So that's the big news out of Washington and how it impacts your retirement and your finances. So it is the first show of the new year, so that means that we need to start to think about our fearless forecast, the annual tongue-in-cheek exercise that we do each and every week. I was looking back through each and every year, excuse me. I was looking back through my notes. I've got notes all the way back to what our predictions were back 10, 15 years ago, even back to when Jack was still doing the show. Jack and I were doing the show together, and so got some interesting data on that. But certainly last year had its share of headlines. And what's interesting is as you go through each month, you can really see that it was a pretty dramatic year in terms of those headlines and ultimately the economic impact on them. Hard to believe, but last January, we were all still talking about COVID, and the daily infections in the U.S. broke 1 million people per day as a result of the Omicron variant. I remember last January, it seemed like a rolling start to the year where around the office there was like this week, these three people are out. The next week, it was another 3 people are out. The following week, it was another 3. I mean, it was like it just really spread dramatically in January. I guess the only positive last January, and only positive to that is that I guess it helps to establish herd immunity if that's a thing. Anyway, so that's January of last year. February, the Russians invaded Ukraine. I mean, you can't make this up. That in the second month of the year, you're already dealing with that terrible situation of that invasion of Ukraine by the Russians. And then in March, guess what? The Fed starts kicking off its rate hikes. In March of last year, started with just a quarter point. But boy, they really added on as the year progressed during the course of the year. In April, Elon Musk says, hey, I'm going to buy Twitter, only to say he wasn't going to buy it and then getting forced into buying it. May, okay, we're back to the Federal Reserve. Federal Reserve announcing a rate hike of 50 basis points. So that was just the first 4 or 5 months of the year right out of the gate. Also in May, I think that was when the draft of opinion from the Supreme Court of Roe versus Wade getting overturned was also leaked. So we're up to May. Okay, when we get back, we'll go into the back half of the year and sort of recap those headlines that had a major economic impact on your wallet. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Doing a little walk down memory lane, if you will, on this, the first show of the new year. Welcome to 2020. 3. It is January the 1st, so that means coming up in the program, we've got to do our fearless forecast. Before we get to that, it's always good to kind of recap what happened in the prior year. Just looking at the slew of headlines that happened, what a year it was. We covered the first half, or almost the first half of the year in the prior segment, but my goodness, yeah, January of last year was all about COVID. February, the Russians invade Ukraine. March, the Federal Reserve starts raising rates, and then in May, they raise them again. You've got that leaked Supreme Court opinion overturning Roe v. Wade in May, and now we come to June, when once again, the Federal Reserve. You're going to hear a lot about the Federal Reserve as we recap these headlines, because in June, the Federal Reserve proceeded to do another rate hike. Hard to believe when you stop and think about it. The amount of rate hikes that they have done, they just started doing them in March. I mean, the speed with which they have increased rates is like nothing we've seen in history. In May, they were just doing their second one to raise rates by 50 basis points on the back of raising rates by 25 basis points in March. And then again in June, they proceeded to do the first of 4 rate hikes that were 0.75%. Also in June, if you recall that period of time, your gas price, your average gas price was above $5, right? And inflation peaked, right? I think it peaked at 9.1% during the course of the month of June. And that just gets us up to the first half of 2022. So welcome into Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're one of Central Florida's longest running radio programs, coming to you on a host of stations throughout the Central Florida region. Also one of the top 25 financial planning podcasts on the World Wide Web. So make sure you subscribe to us so you can see and get notification when we upload new content on our channels. Have any problem finding one of our channels on your favorite podcast or YouTube platforms? Just go to our website, Nelson Financial Planning. You'll see a bunch of icons and you will get immediately connected once you click on any of those. My name, of course, Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week. It's the first week of New Year's. Maybe you got a New Year's resolution about wanting to get your finances in order. Maybe you've got a New Year's resolution about, hey, wait a minute, maybe I should get a second opinion on what I'm doing. Well, hey, that's what we are here for. All of our consultations free of charge, so just give us a call. Go to the website, 407-629-6477, or nelsonfinancialplanning.com. So we're halfway through, right? June, we left off on gas price breaking above $5, right? And inflation spiking to 9.1%. The first of 4 rate hikes that were 0.75% in order. In July, U.S.-China relations kind of hit the skid, although I think that's generally the case throughout the course of last year. In August, despite the Federal Reserve beginning its campaign to raise rates, unemployment actually fell to a low of 3.5% after back-to-back quarters, Q1, Q2 of last year, were negative on GDP. Also in August, the Inflation Reduction Act, which isn't really aptly named, but did have a number of changes to Medicare and electric vehicle credits, things like that, that were part of that. That actually passed in August. September, well, guess what? Fed's raising rates another 0.75%. In October, if you recall the shows in October, one of our fellow certified financial fiduciaries, who also happens to be a National Social Security advisor, Rob Field, joining us on the program talking about the COLA for Social Security, 8.1%. That's good. Many of you, however, were shocked to learn that they means test the amount of money that you have to pay for your Medicare premiums. So you might not have gotten all of that COLA after all if your income was above a certain level. Also in October, Communist Party met, and Chairman Xi broke with tradition and decided that he wanted to stick around for a third term rather than just 2 terms and out. In November, global population passed 8 billion people. So there's 8 billion folks on this good earth. And the midterms, let's not forget about that. I mean, it was a full year, right? I mean, the midterms, FTX crypto exchange collapse, and obviously the results of the midterm show a very narrowly divided government, which in a lot of ways I think is good. And then December, finally got to the last rate hike. Well, because we ran out of months in the year, Federal Reserve cumulatively raised rates by a total of 4.25% overall during the course of last year. Last rate hike came in December, another 0.5%. At least they're not doing 0.75 anymore. Loosening of the rules of COVID and travel out of China, certainly an interesting turn of events considering their highly restrictive policies all these past couple of years. And then, of course, as we were talking about earlier in the program, a massive year-end budget bill that had big changes to taxes, retirement, finances, and the like. So that's the topics, that's the headlines, if you will, for the year 2022. A lot going on. All right. Without further ado, we're going to start to get into the conversation of our Fearless Forecast, our annual tongue-in-cheek exercise started 25 plus years ago by my now late father-in-law, Jack Nelson. Then for many years, he and I did Fearless Forecasts together. And of late, of course, over the past 10 years or so, it's just been me. And we do it every year. Well, mainly to see, so you guys can keep track of whether we're crazy or not. At the end of the day, obviously we don't have a crystal ball, right? And no one can predict the future. Hence, it's an annual tongue-in-cheek sort of exercise. But it's always good to reflect and think about, okay, what might be in front of us as we think about the year 2023. It is a Dow prediction. That's the caveat. Because back when this all started, back when we started doing this, the Dow was generally the more widely known, more widespread market index that people would look at. Obviously, the Dow has some limitations. It's only 30 companies. I think the S&P 500 companies, probably a better reflection of overall market conditions. And certainly this year, you could say where it has certainly been a big difference in terms of performance, right? So for the year Dow 2022, the Dow was down about 9%, the S&P 500 was down about 19%, and the NASDAQ was down about 33%. So that's a pretty big differential between the different market indexes. 2022 will go down in the books as the worst year since the 2008 financial crisis. And if you thought it was a rocky year, you would be correct. Volatility spiked dramatically during the course of last year. The most volatile year since the year 2008, 122 days. During the course of a year, there's about 250 trading days. So you're talking about half the time there were market moves measured by the S&P 500 of 1% or more. Now, some of them were up, some of them were down, but 50% of the time, basically last year, the market was swinging by at least a full percentage point during the course of the day. So if you're looking at it on a daily basis, you certainly would understand where your indigestion and ulcers are coming from, because that's a tremendous amount of volatility. Certainly that was the case on the stock market side of things. But my goodness, what happened in the bond market is even more dramatic. And we just want to share with you some of the stats on that. And we'll do that when we return here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Welcome back to the program, ladies and gentlemen. We have had a jam-packed show talking about some of the big changes that happened just this past week out of Washington that affect your taxes, your retirement, your finances. Also, a recap of the year that was 2022. Not a particularly great year for the markets and the economy, but when you go through that host of headlines that happened each and every month last year, my goodness, it was certainly a year filled with a lot of dramatic headlines. Chief among them, of course, is the Federal Reserve. It was a continuation of raising rates at a pretty remarkable clip. And certainly that created a lot of volatility in the markets. The markets as overall had their worst annual performance since the year 2008. So not a great year by any stretch of the imagination, but certainly that is directly reflected to the ongoing ups and downs of the economy. Last year also a very volatile year as well. 50% of the time, or nearly 50% of the time, on a daily basis, the market was moving up or down by at least 1%. So pretty dramatic year overall. I think even more dramatic is the impact in the bond side of things. And I want you to stop and sort of think about this. At the beginning of last year, you were able to borrow from lending institutions money on a 30-year basis and pay interest rates that were 3%, some cases even lower. Okay? So conceptualize that, if you will. When the year closed out, there were money market funds paying more than what it cost you to borrow money at the beginning of the year. Beginning of the year, you're able to borrow money at 3%, sometimes even lower than that. End of the year, you got money market funds paying 3.5%, approaching 4% in terms of the 7-day effective yield. Isn't that just a dramatic turn of, that's the most dramatic turn of events in terms of cost of capital, cost of dollars, utilization of dollars that we've ever seen. That's a full 7%, almost kind of, swing, if you will, to borrow it, be able to borrow at 3%. And now you're sitting in cash and you're earning more than 3%. That is really unheard of and really highlights how dramatic the last year was, the year 2022. So anyway, as we've promised, our fearless forecast. So before we get to the actual number, we thought it would be good to talk about our track record, right? Because you want to know if we're doing these fearless forecasts, if we're at all close to accurate on our ability to do this. The reality, of course, is that, remember, it's a tongue-in-cheek exercise because you can't really predict the future if you didn't realize that. Anyway, here's what we've done over the past 10 years. For the past 10 years, 4 of them we were spot on. Actually kind of forecasted it pretty well within like 100 or 200 points of the Dow, so pretty close. 3 of those years, so the past 10 years, 4 right on the money. 3, the markets actually did better than what we thought they would do. So, okay. And then there were those other 3 where markets did much worse than we thought. So overall, we're going to give ourselves a 70%, which, if you're grading on a curve, what is that? Still a C? Does that still give me a C? So 70%, we were either spot on or we were less than what the market did, sort of under-promised and then over-delivered. So only truly wrong like 30% of the time. So I guess that's pretty good. Unfortunately, though, here's the unfortunate part. For the year 2022, we were, that was one of our bad years. We were way off on that. We projected a Dow of 39,000. Dow closed out at around 33,000. So one of our worst years, about as bad as what we had done back in 2018. So that's kind of how it goes when you're predicting the future. So on to the year 2023 and some thoughts on that. For the year 2023, certainly this past week, the economy showed some fresh signs of potentially slowing. If you look at The personal spending numbers that came out for November are still kind of showing a little bit of a reduction over prior months in terms of personal spending. Federal rate hikes cumulatively 4.25%, starting to certainly have an impact. If you think about that impact that they're going to have in terms of a drag on the economy as you increase the cost of borrowing, certainly that is starting to make its way into the overall markets and the overall economy. So what that probably translates into is continued volatility. We talked about last year being a highly volatile year. Expect that to continue into 2023, particularly in the first half of 2023. So we think that particularly in the first half to be a little bit more volatile, potentially the back half, though, to get a little bit better as the Federal Reserve starts to back off and the economy starts to sort of recover from that period of time where the Federal Reserve is increasing interest rates. So markets are certainly down as much as they are this year. Strongly suggests that perhaps the markets have already started to price in a recession, whether that's we're in the middle of that, whether that's already happened, whether that's going to happen. The reality is that markets are typically down 20 to 30% in preparation for a recession, and so now the overall market as measured by the S&P 500 down about 20%. So maybe that's sort of already priced in there. In September, in fact, the S&P 500 was down closer to 25. So again, you start to think, well, if there's a recession that's going to happen, and here we are all talking about it, chances are the market already knows that. Maybe the market's already priced it in. And so that's part of what our thinking is, because ultimately in the back half of the year, the markets will then start to look forward to 2024, potentially see a Federal Reserve that maybe isn't even raising rates. Maybe they're having to cut rates in order to kind of keep things on track. So here's where we come out on this. We think our prediction of 39,000 a year ago is actually going to be the accurate one for 2023, plus maybe a little bit more. And that's because I like nice, round, even numbers. There's the highly unscientific part of the Fearless forecast. But here it is. Lock it in. We're going to go with 40,000 on the Dow come December 31, 2023. Mark it down. I know a lot of our listeners like to do that, and we'll see where we are a year from today. But to recap, should be a relative continued volatility in the first half of the year, but by the back half of the year, things should start to be getting back on track. Start to see the markets start to move positively. And our prediction on the Dow, 40,000 by year end. Again, we predicted 39,000 for this past year. We were a little off on that, a lot off on that. And so we think we're going to be right this year. And then we'll add a little kicker to it as well. So write it down. We'll see where we are at in terms of our Fearless forecast for the year 2023. That's about all. We're going to wrap it up and get on out of here for this week's episode of Dollars and Cents with Joel Garris of Nelson Financial Planning. If you like what you heard and want to learn more about how we can help you improve your life, visit our team of certified financial fiduciaries at Nelson Financial Planning, either going to our website, nelsonfinancialplanning.com, or you can call the office at 407-629-6477. Yes, we do have live people that answer the phone and schedule a free conversation with us here in the new year 2023. Happy New Year from all of us at Dollars and Cents with Joel Garris of Nelson Financial Planning.